Next question. Mrs. X Limited is considering purchasing of a machinery. Life of the machinery is 3 years. Purchase price of the machinery is 10,000. Cash inflow at the end of the each year is likely to be as under. End of year 1 3,500, end of year 2 4,250, and end of year 3 8,750. The discounting rate of the cost of capital is 10%. By adopting following criteria, decide whether machinery should be purchased. That is the question. The first one is, as usual, we understand is NPV criteria, and there is a new criteria which has been introduced over here. That is called IRR criteria. Year 1 to year 3, discounting factors information have been given to us. I request all of you to compute the NPV of the project, and then I'll explain you how to calculate IRR. Now, first year, cash inflow is 3,500 into 0.9091. So, present value of the cash inflow is 3181.85. 4250 into 0.8264. 3512.2. 8750 into 0.7513. 6573.88. Present value of the cash inflow 13,267.93. Less investment. Amount of investment is 10,000, and difference of both of them is NPV 3267.93. So based on NPV criteria, the machinery should be purchased because NPV of the project is positive. Right on answer. As NPV of the project is positive, comma, based on NPV criteria, comma, the project should be accepted. This is the way we are required to take decision. Next is IRR criteria. Let us have an understanding that say how to take decision using the IRR criteria, and we are going to have understanding that say the how IRR is calculated. Everybody is requested to pay attention. We have made calculation something like this. Year 1, year 2, year 3. Listen carefully. Cash inflow is 4,000, 7,000 and 18,000. Let us say that the discounting rate is 25%. And based on that, say we compute the present value of the cash inflow. And present value of the cash inflow is an amount of 16,896. We understand logically like this, that $16,896 is the maximum investment that I can make in the machinery. So if at all we have been provided with the information that the actual purchase price of the machinery is 15,000, then in that case we will take the decision that say we should buy the machinery. Why? Because 15,000 is less than 16,896. Suppose actual purchase price of the machinery is 18,000, then in that case we should not buy the machinery. Why? Because say what we are going to receive is 16,896, and in comparison to that, say 18,000 is required to be paid. This is the way we have understood, say the kind of the decision making by using the present value of the cash inflow concept. Now friends, over here, as far as this question is concerned, in that first year cash inflow is 3,500, second year cash inflow is 4,250, third year cash inflow is 8,750. This is the cash inflow. Discounting present value. Whatever is the present value of the cash inflow, less investment. Amount of investment is 10,000. And with that, we make the calculation of the NPV. Now understand carefully what I am going to speak. What is IRR? IRR is the discounting rate at which NPV of the project is 0. What is IRR? IRR is the discounting rate at which NPV of the project is 0. That is called IRR. Means we are required to make search for such a discounting rate at which the present value of the cash inflow and present value of the cash outflow is same. We know that at the rate of 10%, the present value of the cash inflow is 13,267. Now we are required to make the computation of the such a discounting rate at which NPV of the project is 0. Now how do we compute it? What does it mean? I just explained that to you. However, before that, say I am focusing on a point. I'd say how do we calculate? Dear students, we already have understood that cost of capital and NPV of the project have inverse relationship. With the increase in the cost of capital, NPV is falling down, and with the decrease in the cost of capital, NPV is going up. That is the way both of them are having inverse relationship. At the rate of 10%, coincidentally, we already have positive NPV. So we are required to increase the cost of capital for the purpose of calculation of IRR. Suppose we make the calculation of NPV at the rate of 15%. Let us assume that NPV is again positive. At 20%, NPV is, let us say, again positive. Like that, say we are required to make the computation of the NPV till the time we get one positive NPV and another negative NPV. Let us say at 23% we got negative NPV. Okay, so once you get one positive NPV and another negative NPV, afterwards both of them are required to be interpolated in order to calculate the IRR. Means at the rate of 20% NPV is positive, at the rate of 23% NPV is negative. So what must be the discounting rate at which NPV of the project would be 0? So that interpolation is required to be done. Whatever this process that we have done, friends, that is given a technical name as the interpolation. Suppose after doing interpolation, we find that say the internal rate of return is 23%, for example, so 22%, for example. It means that say that 22% is the discounting rate at which NPV is 0, and that is the maximum cost that I can afford to accept the project. The way we had 16,896 as the maximum price that I am ready to pay to purchase the machinery, and if at all actual price of the machinery is less, then in that case I will buy the machinery. If actual price is more, then in that case I do not buy the machinery. Similarly over here, what happens at IRR is the discounting rate at which NPV of the project is 0. It means that say I can afford maximum cost equal to the IRR. So what happens at say internal rate of return of the project is required to be compared with the cost of capital. If IRR is greater than cost of capital, in that case you should accept the project, that is you should purchase the machinery. If at all IRR is less, means what you can afford maximum is 22 and what is the actual is 30. then in that case the project is not worth accepting, you should reject. And if at all both of them are same, at that point of time you are indifferent whether to accept or not. So friends, it is considered that, or it is like said that IRR is calculated using trial and error method. Why it is said that it is calculated using trial and error method? Because basically, say over here, we do not have any clue that where IRR would be falling. We understand at the rate of 10% NPV is positive, that say we already have found coincidentally in the first part of the question. Suppose directly the second question is asked upon, that is calculation of IRR, then even that 10% clue we do not have. So what happens at say, you are required to adopt trial and error method for the purpose of IRR calculation. Randomly, you have to select a discounting rate at which you have to find NPV. Now whatever that's a rate at which you have found NPV, that rate is required to be increased to calculate the lower negative NPV. That is in order to calculate the reduction of the NPV, and you are required to decrease the cost of capital for the purpose of increasing NPV. What is the first step that you take? That will decide what would be your subsequent step. You have to keep on doing this till the time you have one positive NPV and one negative NPV. This is the process by which IRR is calculated, and so this is the definition of IRR, and this is the way we take the decision. So write down heading IRR. In bracket write down internal rate of return. In that write down first point, IRR is indicating a discounting rate at which NPV of the project will be 0. Second point, IRR is indicating maximum cost of capital that we can bear for the project. Third, from decision making point of view, comma, IRR will be compared with cost of capital of the company. Write on this table IRR greater than cost of capital. The decision is accept. IRR less than cost of capital. The decision is reject. IRR is equal to cost of capital. The decision is indifferent. This is the way we have to take decision. Fourth point, calculation of IRR is made as under. In that, write down A, taking any cost of capital comma calculate NPV of the project. B, calculated NPV may be positive or it may be negative. If calculated NPV is positive, comma, increase cost of capital, comma, to reduce NPV to negative. If calculated NPV is negative, comma, decrease cost of capital to increase NPV. Full stop. C point. Above process will continue till the time we get positive and negative NPV, full stop. One thing that I would like to discuss is, now in this question where we are required to find IRR at the rate of 10% NPV is positive. Okay. Now I dictated a condition that we should be having positive NPV, negative NPV. Why? Because 0 is a value which is lying between both of them. So we'll compute both of them and then we will interpolate. Somebody in the classroom is telling me that, sir, I want to calculate the next NPV at the rate of 99%. Usually I will get negative NPV. Then can I interpolate 10 and 99? That is a question that a student may have. Giving reply to this question, that's the answer is no. You cannot do like this. Why you cannot do? Friends, we cannot do interpolation of those two. Why? I explain that to you. Friends, this diagram which I have shown to you is technically wrong diagram. This is not the completely correct diagram. Basically what happens at say, with the increase in the cost of capital, NPV is falling down. There is no doubt about it. That is, cost of capital and NPV have inverse relationship. That's true. However, actually both of them are having disproportionately inverse relationship. So it goes like this. So with the increase in the cost of capital, NPV of the project is falling. However, so with the increase in the cost of capital, NPV is falling down disproportionately. It is not decreasing proportionately. So the diagram is like this. In spite of that, IRR criteria makes an assumption that say both of them are having proportionate relationship, and they give the answer of the internal rate of return. So IRR is giving this answer, and actually IRR answer is this. So there is a small margin of error over here. There is a small margin of error over here. That is the reason say we should be having less difference so far possible at the time of final interpolation. See over here we understand, let's say more and more difference that you take, with that so the margin of error will increase. So when we are doing final interpolation, at that point of time we should be having maximum difference of 3%, not more than that. Further, both of them should not have a difference more than 3% at the time of final interpolation. Full stop. Remember friends, importantly that say that 3% rule is not applicable at this point of time. Because at the rate of 10% you got positive NPV and you want to get the negative NPV and you feel that IRR is far that is ahead. Then in that case you can immediately increase it. So at this point of time the 3% rule is not applicable. That rule is applicable only at the time of final interpolation.